We are still in the midst of earnings season in the U.S. and more recently in Canada as well. Our next guest says earnings season remains strong, but investors have become demanding about the quality of earnings. Let's bring in Dec Mullarkey, Managing Director of Investment Strategy and Asset Allocation at SLC Management. Dec, thanks a lot for joining us. How would you characterize so far U.S. earnings season?
Great to connect, Paul. It's been very, very strong. They've over-delivered. The expectation was, and two-thirds of them have reported already, expectation was 8% EPS growth. It's come in at 12. So that's all, that's all great. And it still looks, it continues, everything we see rolling, coming in is not changing that picture. But the one thing that's interesting, of course, earnings are backward looking. So that's all great news. But the one thing that investors paid a lot of attention to was the quality of earnings. And by that, I mean, they were expecting most companies to beat. So if you beat, it almost was a yawn. And they rewarded it a little. But the price increase and the price bump that companies got, in a single day was well below average. So everybody was looking at that. However, if you missed, you really, really were harshly treated. Just to give you a sense, like the median company that missed was down like 3%, the following day, where on average that would have been 2%. So that's where investors are paying a lot of attention to the quality of earnings, and that's what they're focusing. And no surprise, that's what we're expecting this year. That will drive the market is earnings and margin, expansion or retention, and not multiple expansion. So they're looking to the right thing, and that's where we are right now.
One thing that a shift in the market that we began to see in late 2024, and it's carried over into 2025, was a move away from the obsession with the Magnificent Seven tech stocks. We're seeing it in share prices. Are we seeing it in earnings growth? Is the gap in earnings growth between the tech leaders and the other 493 closing?
Yeah, great question. And it absolutely is. That was one of the things that were coming through loud and clear in the numbers. And just to give a perspective, like the median company, returned 7%. They were expecting, a 6% kind of increase in EPS. So that's narrowing that broadening out is positive. And I would also say there was another interesting development. I mean, the DeepSeek sent shudders through markets. And initially, the AI gang was a little affected by that. But on reflection, everybody concluded, well, this is positive for if you will, broad tech and broad AI in general, because we're showing that we can bring down the cost curve, and that will then enhance and lead to greater adoption. So I think some of that optimism is now kind of coming back and broadening out that other companies might be able to get in on this more quickly in embracing these and increasing productivity. The other interesting thing was that coming into the year, the big tech were saying we'll spend $250 billion on AI research and that investment. They have now raised that to $330. So under the covers, there were some interesting shifts and the embrace of this DeepSeek, which initially looked like a threat, but was then reinterpreted to, well, this is just positive because everyone else can embrace this, and we can kind of move forward maybe quicker to realizing revenue from AI, but also productivity from AI.
Jerome Powell, the chair of the Fed, made it clear in testimony this week that the Fed is not in any kind of hurry to cut interest rates. And this morning we have inflation numbers in the U.S. that have pushed out the market's expectation of rate cut number 1 in 2025 all the way to the middle of December. How do you think equity markets, which are down today on this news, how do you think they will grapple with this information over the weeks and months to come?
I think they will process it and kind of reset. It's interesting. What happens on the first day may not be the lasting impact, but there is no question that it certainly increases the narrative that the Fed will have to stay higher for longer. The large cap companies have less of a problem with that. The small cap actually are much more vulnerable. So we'll see how that comes through. But there was, to your point, the expectations keep getting reset. And the other thing that's happening is that the actual terminal rate where the Fed ends cutting, that's pretty high right now. It's closer to 3.75. That's where they'll end versus 2.5, say, pre-pandemic. So we're at that point where you do feel it's higher for longer. Companies, I think, feel they can manage with that as long as rates don't go up, don't increase from where we are right now. So I think they'll be able to manage to some degree, but we've got a lot of other uncertainty, and that's what they're grappling with as well. And they have not been given a lot of forward guidance at this point, even though backward-looking earnings have been very strong. They've been very, very careful about any forecasts they put out there because they just want to see where everything settles on tariffs and the U.S. agenda at this point.
Dec, thank you for your insight. That's Dec Mullarkey, Managing Director.